Well, welcome everybody to our latest webinar series here as part of the Masters in Wealth Management program at Columbia University SPS. I am going to give some overarching remarks and then we'll get right into the program itself and you'll get a chance to meet our distinguished panel. First, let me remind everybody about what Columbia is doing. It has a formal Masters in Wealth Management program. It's a 16-month part-time asynchronous program that is specifically designed for working individuals as well as folks from both across the country and across the globe. 10 courses are taught by leading industry scholar practitioners, and it's centered around not just learning about the content, but also using problem-based learning that helps clients understand how to advise wealthy, complex, ultra-high net worth, and family office clients, as well as satisfying the educational curriculum requirements for sitting for the CFP exam. Today's conversation is about one particular vertical, industry vertical, if you will, within the industry, an increasingly important one, family offices. And for those of you who are looking to expand your opportunity set to include some of the wealthiest families across the country and across the globe, it's important to understand how they're structured, how they work with Wall Street, what are some of the both consistent and nuanced ways that the best advisors are serving and advising them. And to that end, we have some great panelists who can talk to you about that. And they are an important client segment, not just for banks, but brokerage firms and asset managers and increasingly RIAs and MFOs. It's hard to really say how many family offices there are globally, but if you just look at the numbers, there's about 18,000 families globally that have over $250 million in net worth. And what makes those families, as you can appreciate, particularly important, not just to the wealth management firms, but also to society overall, is that they represent about 8% or just under of the number of ultra high net worth families with over in aggregate. But they control 50% of the wealth, no surprise. And family offices are going to continue to grow both in size, sophistication, and they use various products and solutions and advice that hopefully the attendees on this call represent. So to that end, I'd love to take a moment first and have you meet our various panelists, Steve Bedurtha, Michael Montgomery, Sid Malhotra. And I will not do them a disjustice of trying to explain their backgrounds. I will instead ask them to do so. Why don't we just start in no particular order? Michael Montgomery, maybe we'll start with you since you appear on my screen directly below.
Well, first of all, thanks, Bill, for inviting me to join today. It's really exciting what's going on at Columbia. So in terms of my background, I've spent the majority of my career working within RIAs, wealth management firms, multifamily offices, but most recently in the last 10 years have been leading single family offices. I currently today serve as the CEO and CIO of what I'd characterize as a mid-size, multi-generational single family office. And prior to my new role here, spent the last 7.5 years as the CEO for the Ford family in Detroit, Michigan, which was definitely in the category of a much larger single family office with over 45 employees and over 50 distinct households. And so certainly can give the group a broad perspective because having sat now in the chair of CEO and now CIO of a single family office, but having also been on the other side and worked within RIAs, multifamily offices, and wealth management enterprises, probably have a bit of a unique perspective of how all of that ecosystem works together. So hopefully that gives everyone at least a little bit of context for my background.
Great. Thank you, Michael. Sid, why don't you go next?
Sure. It's great to be here and really proud to be helping Columbia and further give folks an understanding of how to best work with family offices. I'm the Chief Investment Officer at Cactus Capital. We are an institutional single family office based in New York City, managing capital on behalf of a private equity executive. Been here for about 8.5 years. Our family office, to give some additional context, consists of me and 3 investment professionals and 4 folks on the operational and back office side. Prior to joining Cactus Capital, I was working with the Pritzker family in Chicago, JB and Tony Pritzker at the Pritzker Group for about 6.5 years. And, originally got into the investment business working at a hedge fund called Citadel.
Thank you, Sid. And then finally, last but not least, Steve Bedurtha.
Thanks, Bill. I'm Steve Bedurtha, and my career in the industry has really covered executive positions in overseeing investment platforms, principally for one major national wealth management organization and also similar role at a major private bank. These days, in addition to teaching the investment course called Investment Planning in the Columbia Wealth Masters program that Bill referenced and is also a faculty member of, I also have a private practice, and I do find myself working a lot with both families and wealth advisors who are trying to find more productive ways of collaborating, partnering, and having productive relationships.
Great. Well, thank you. As you can appreciate, we have on the panel amongst the 3 guests broad experiences, those that are the customer clients of the industry, as well as Steve, who oversaw an important aspect of the industry for multiple firms. Let me just sort of add my background. It will be relevant. I've spent a career working with very wealthy families, mostly at banks and large brokerage firms that included serving with a number of very, very large family offices, so much so that I ended up writing a book that Columbia Business School published on the topic. And one of the reasons why we are having this seminar is because I sort of learned through experience both the challenges and the opportunities of working with very wealthy families. And I wanted to bring those experiences to not just the students of the class, but the participants more broadly in the community who as well hope to learn more and be more successful. So I'll kick it off by first talking to the clients themselves. And so these questions are for Sid and or Michael. Please feel free to answer them in whatever order preference you have. But how does your family work with banks, brokerage firms, RIAs, and MFOs? What do you actually do with those various firms in each of those 3 industry verticals?
Well, Bill, I'm happy to jump in, I guess, first. I'll answer from the perspective of kind of 2 types of offices. The one I'm currently in, which again is a mid-size, and the structure is a bit different. And then I can certainly answer within the context of my tenure at Ford. And the reason I bring that up, and I'm sure we will talk about this, is the structure of your service model, your operations and overall client service model will have a lot to do with how you engage with a financial services firm, an RIA, and MFO, a brokerage firm. But regardless of the structure, I'd say there's probably kind of three ways or kind of 3 categories of how the current office I'm at engaged and how the Ford family engaged. At the base of the house, or the foundation of the house, we certainly engage with what I'll call trust banks for custody and safekeeping of the family's wealth and assets. Certainly look to those institutions for their lending capabilities, their depository capabilities, and we certainly engage that type of institution also for back office support for all our investment vehicles and pooled vehicles, if you will, across all asset classes. And so kind of put that at the foundational level, because whether I'm at a big office, medium size, or small size, you've got to have some sort of custody and depository and lending foundation there. And so that's kind of stage 1. Stage 2, I'd say, is moving more advanced. We certainly in my prior role and current role engage with larger brokerage financial institutions for a number of things: research, depth of domain expertise in particular asset classes, certainly capital market support, whether that's for hedging, currency, block trades for concentrated positions. So all sorts of more what I call advanced support. And then finally, certainly for some of the larger firms, they've developed non-financial capabilities. And so certainly have been engaged with some of the larger institutions on philanthropy, governance, even cybersecurity and IT, education, financial training and literacy. And so it really kind of depends on what the family's needs are at a particular time, but those are some kind of core underpinnings at the brokerage firms. And then finally, on the RIA or MFO side, I mean, there's a role to play there too, because in the last 10 years, certainly I've engaged for what I'd characterize as a completion strategy with at least one or more different multifamily offices for some sort of expertise they may possess. And a lot of that has to do with their client set and what has brought them along from an intellectual capital standpoint. And an example would be in the governance arena. There's some MFOs that have done extensive governance structuring for families. And so they have a lot to say about it. And maybe even their origin family, before it became an MFO, went through a lot of governance evolutions. And so they're ripe to really help advise single family offices that are trying to solve that picture. So those are kind of the how I think about the pecking order of base of the house, custody, banking, lending, capital market support for more advanced work. And then finally, MFO or RIA for all sorts of what I'd call very custom niche specific needs.
Thank you, Michael. It's very helpful. Sid, before moving on to you, I forgot one important housekeeping item, which is we would very much welcome your questions. And please feel free to post them. However, do so through the Q&A icon on your screen as opposed to the chat. And feel free to do so as the discussion unfolds, although we will take some time at the end to respond to formal questions that have been posted. So with that having been done, Sid, how are you working with various firms across the industry?
Yeah, no, I think Michael's explanation was very thorough, and I think most of those points apply to us. At my current firm, we use banks in a few different ways. It's as simple as cash management and sort of being prudent with managing cash, all the way to doing derivative and structured note investments with the banks that are customly structured for us. We also will use banks on the capital market side, whether it's to issue, stocks or, co-investments or direct investments into private companies, whether they're venture-backed, real estate, or private equity-backed companies. We'll also use them, I'd say, to, get access to thought leadership and research. I think many of the banks have, a few areas that they're sort of strongest in. And so it's nice to have relationships with several different banks that have, different attributes where they're sort of the strongest and kind of just see the different views that the banks might have. I agree with Michael that, credit facilities and lending is very, very important. So we do have banks that are really more focused, I'd say, on that aspect of our relationship with them. And then on the non-financial side, educating the next generation, I think is really helpful. While my team and I can do it, I feel that it's always nice to sort of have a third party help with that process as well. And bring sort of best practices in terms of what they've seen with other families to the table, and talking about philanthropy and just how to be thoughtful there and have really impact and measure it is another way that we found a lot of success working with different banks and RIAs.
Great, thank you very much. So here's the the question that really prompted this session. What are some of the challenges that you face either working with the firms and or the advisors who represent those firms across the respective areas of need that you just articulated?
Sure, I'm happy to take this one first. I think one thing is sometimes certain groups or individuals at firms are very product driven and not really solutions driven. As a institutional family office with an in-house investment team, we're really looking to partner with banks. And so we're really looking to look to them and their expertise to deliver to us, a few things that they're really best in class in. So I feel that, certain firms and individuals do a better job listening and being really solution driven versus just saying, hey, this is what we do best and this is why you should do it. Whereas it's, not always the best fit for us. So I think that's something just really critical, just having a good ear and being solutions orientated. And, if it means working with other firms outside of the organization you're with, having that openness can sometimes be really, really helpful in terms of building trust and credibility with the family offices and the folks you're working with.
Mike, anything?
Yeah, I would echo that as well. I mean, definitely a big challenge just due to the incentive structures at certain organizations that perhaps they're trying to be a little more product versus solutions driven. I'd say probably a couple of other areas would be just not necessarily getting to know the structure of the family office, and instead just shotgun blasting, solutions out there. And the reason I bring that up is depending on what your overall philosophy and framework is for your family and your family office, that's going to have everything to do with what type of deal flow or idea generation we're going to want from any type of firm. And so challenge that certainly I think Sid or I have is there's only so many hours in the day. There's only so much time you have to filter through things. And so you're hopeful that you're going to get ideas that are going to fit together with what your framework is. And I've seen that can be a challenge and has been historically with some organizations. Say another area, there's a misunderstanding that family offices don't want to pay anything. I think the two family offices I've been in will pay for value, but we want transparency. And so a challenge has also been with some organizations that they have not been as willing to unbundle and show all their core components of fees and all the layers there. We're happy to pay if it's the right solution and it's going to create value, but we are meticulously focused on value relative to cost, and so certainly need that. Then finally, I would just say lack of flexibility on certain structures. I mean, back to Sid and I have both mentioned lending, trying to find firms that are not challenged in their thinking around how to structure collateral, because there's about 50,000 ways to do structures and deals, and certainly with some banks, they're just, or institutions in general, just aren't that flexible.
Yeah, that's very helpful. I'm gonna, if I can, drill down on two important things that you guys mentioned, just for further clarification. And Sid, I'll start with you. My presumption is that you know that many of the firms that you're talking to actually have product, that them having product in and of itself is not a bad thing. Indeed, you're going to those firms sometimes because of who they are and the product that they've got and their expertise. So when you talk about, sort of, I'm not sure if you used the term objectivity or independence, that kind of stuff. Could you maybe expand a little bit more on that? I think I know the answer, but I'd be kind of curious what it is that, you would say to an advisor who's coming to you from one of those firms that indeed is well known for having products. How should they approach it?
Yeah, no, I think like Michael said, one of the things we really focus on as well is just transparency on fees and just making sure we fully understand that. That's really critical. But we're trying to, I guess at our family office, there's a lot of investing we do in-house. And so what the bank's bringing to us really needs to be additive and something we can't do on our own, or something we could maybe do on our own, but we think partnering with the bank makes a lot of sense. And in terms of, just access to a better investment, better execution, thought leadership, some sort of strategic angle they bring to it. Those are things that, I think are very, very helpful for us and really make it sort of a win-win partnership. And so I would just reiterate, our philosophy working with banks is, while we're obviously a client, our mindset's more partnership model orientated. Let's view this as a partnership. Let's start with something and hopefully we can grow it. If we do more business with you all, that's good for everyone. That means we think there's value. It's good for you guys. And that's kind of our mindset, I'd say, at the onset. We do, I guess, sometimes have a negative initial, knee-jerk reaction to proprietary products. We kind of, I'd say, appreciate more the open architecture that some of the banks and RIAs have. Certain folks are much more open on that front than others. I personally think the world's sort of evolving to that open architectural model. That's my philosophy. I just think it's the best way to maximize performance. And you can always figure out how to get compensated on it. But maybe those are some thoughts I have, but I'll pause and, let Michael chime in as well.
Yeah, so you pretty much check the boxes for me. I mean, in terms of certainly, we're always going to be willing to look at a proprietary, solution if there's an edge there, or it's more efficient for us to engage than do it in-house. But yeah, I think you hit on all my checklist.
That's helpful. And then I'm going to just, I can't escape the pedagogical orientation that comes with being a lecturer on this topic. You used the term partnership. I think an extension of that would be, and I've heard this from other family office professionals, that they want curated recommendations, curated based on what they know about you, what your needs are, where your areas of interest are, as opposed to, I think one of you used the shotgun approach. Would you mind maybe elaborating on that if I'm accurate?
Sure. Yeah, I think a lot of advisors think that, just showing all this, flow, for lack of a better word, or product, maximizes the odds they can do something with the family. But I think most families, especially the more sophisticated institutional ones, are pretty focused in terms of their own mandate. There's a pretty clear investment philosophy and mandate. And then they're also very focused in terms of what they will invest in, what they won't, how they'll do it. And there's some openness there as well. So I think, yeah, offering curated, solutions, not products, is very much the best in class approach to dealing with institutional family offices. Again, we're willing to pay fees if there's value being provided and we think it's best in class. You just have to realize that we're being shown a lot of different things from a lot of different groups. And so it's too much flow at times.
Right.
Yeah, Bill, I really like that term curated. I mean, I think it gets back to knowing your client, knowing the family office and what their mandates and frameworks are, and honing and refining what you're bringing to them. So, for example, in my prior role, we had a full-blown in-house investment team and people that are asset class subject matter experts. And we had a framework for the size of opportunities we would do and the types of opportunities. The more our outside institutions understand that, the more we can really be efficient with one another on what we're going to look at and what we're not going to look at, versus, again, kind of shotgun blasting out or less than eloquently called spray and pray and hoping that a deal is going to maybe hit. You don't have time for that. Whereas contrast to today, the office I'm in, we work very closely with an outside third party, very well regarded investment consultant, and I have a smaller team in-house. And so what my needs are here are going to be different than what they were when I had a full-blown investment team.
That's helpful. There was a question about whether or not you use banks or brokerage firms for alternative assets. Probably a very quick answer to that. Sid?
We have for a little bit. I think the issue we've run into sometimes is, many times we're talking to those firms directly. And so in those situations, to be candid, the bank's not really providing much value. There are other situations where a bank's platform might have, phenomenal access to a hard to access venture capital firm, for example, that we could never access. And in those situations, by all means, it's great to partner with a bank to get access to those investments. We will also look at co-investments and direct investments in the alt space, so venture capital deals, buyout deals, real estate deals as well, where the deal flow is coming through the private bank.
How about you, Mike?
Yeah, I would certainly say access has been probably the most common reason why we might have engaged on the alternative front, particularly because venture is so hard, to get access, to certain managers. Beyond that, in my current role and prior, I wouldn't say we've done much in the direct or co arena, because most of that has been with fund managers we already have deep relationships with. And as Sid said, there's just not anything additive to adding another layer into that process. But I never say never, because I go back to unique asset classes. What is an alternative? I can tell you we engaged very heavily early on to educate ourselves on how to deploy, if at all, capital to blockchain and crypto, and talk to some of the larger institutions to see, do they have any type of, edge or proprietary knowledge to help educate us there. So, I never say never. It's just probably not in the top 10 things we engage with.
Sounds good. All right, well, let me pivot to Steve. You heard many of the things that Sid and Michael have mentioned, both what they do and what they're challenged by, and best approaches by advisors. Based on your experience, why is it that advisors and firms struggle to both cover and serve family offices? Because they, in fact, do struggle, as having spent many, many years at those various firms. Be curious your thoughts.
Yeah, I think there are a couple important things to focus on here or see clearly. And one of those is role alignment, which in their own way, Mike and Sid have touched on. So when you think about it, a successful wealth advisor, someone who's really at the top of his or her game, is in many cases a comprehensive wealth manager. And that's the kind of wealth advisors that we like to develop and cultivate in our program, Bill. But they're capable of helping clients do financial planning, tax planning, investments, potentially lending and liability, balance sheet management, all of those things. And for the kinds of clients that represent the bulk of their relationships, let's call it $1 to $10 million of assets, high net worth kind of client. When that advisor with their comprehensive wealth manager hat turns to an established family office, right? That quarterback already is employed by the family office, by the principal, by the owner of the wealth. So I think there needs to be almost a shift in focus and mindset to sort of say, look, I'm going to be a role player here. And the key thing I need to figure out for this potential prospect's benefit and mine is whether there is a role for me to play here. And how can I be an important part of an ecosystem, an important contributor in that ecosystem? So that's a really important thing to think about that. And if you're wired to be a comprehensive wealth manager, you need to think about, can you rewire? Does that make sense for your practice, et cetera? Another important distinction I would say is to delineate between established family offices, if you're thinking about it from the standpoint of breaking into this market as a wealth advisor, and I'll say emerging family offices or family offices of the future. So where potentially the odds are much more likely that a traditional wealth advisor, through cultivating a successful entrepreneur before the wealth is fully made, that you'll have an opportunity to get to know that person, play an important role early on, and potentially make a lifetime relationship that can sustain the inevitable onslaught that will come from competitors when wealth is realized.
That's a particularly valuable point for wealth advisors, is that there's elements of what you've done so successfully throughout your career that you should replicate and continue. There's other stuff you should consider changing a little bit in terms of your orientation, and you use the distinction between whether or not you're used to being the quarterback or used to being, one of the role players that assists in, task execution, if you will, or opportunity execution. Let me ask you the question about the firms themselves, the structures, the compensation plans, the fiefdoms, the incentives. Do those play a role, whether at a bank or a brokerage firm or both, in creating challenges for family offices and their coverage by wealth advisors?
Yeah. Shall I respond to that, Bill? Yeah. So you're right to focus on, second obstacle would be the reality and the perception of misalignment in incentives. And I think that, it is important. I think it's important, particularly with any client, but certainly an established family office is not going to want to spend time dancing around the issue of fees. I mean, that's just like an invitation to be shown the door. And so I think it's really important to understand, do you have the flexibility to price your business in a way that can make sense to a family office. Mike said, it doesn't mean everything's got to be on the cheap. So I think the important thing is almost a communication point. It's really a matter of do not dance. Say, this is how I work. This is what I typically charge, and ask, how does that compare to what you're accustomed to? And if you can adjust, if you need to, figure out if you need to adjust, but get to that incentive question, get that right out on the table and take it off the table because you've addressed it as quickly as possible.
Got it. One of the areas that Sid made mention to, or Michael, I can't remember, had to do, and I think it was Michael, with respect to, they had to understand, let's assume you're a bank and you're lending money, or brokerage firm, you're lending money to family offices, is that you've got to understand that family offices, given their size and their sophistication and their structures, oftentimes require a little bit more of a nuanced underwriting, nuanced structure, nuanced, policies and related guidelines. Steve, kind of curious if you see that as either an inhibitor or a facilitator based on the various firms that you work for. Were some better at it in accomplishing that and others more challenged by it?
So this is maybe both daunting and encouraging for wealth advisors who want to do more with family offices. I think a lot comes down to the capabilities of the individual in the firms that have these resources. And does the firm support their own entrepreneurial activity to stitch together the services, the customized services, priced the right way for a particular or more than one particular family office? I was going to say, Bill, that helping a family office navigate a large firm with real resources, that is a real skill. So the individuals that have succeeded in larger private banks and wealth management organizations that I've seen have proven themselves to be extraordinary in navigating, helping the client navigate the firm, the supplier, if you will, the advisor, the supplier. And that's not, in these large organizations, are like, many of them are filled with specialists, right? Because you're trying to deliver a specialist expertise. The stitching together part, which doesn't necessarily require you to be the expert structurer of a loan, but it requires you to have a good relationship and a productive relationship with that person, so that when you call that colleague, you can get a productive response to go back to your family office client with. So I think it's a combination. The table stakes are the resources, the capabilities of these large firms. The special skill is in the individual who sees that they're going to build their business this way.
So I can't help but notice Sid and Michael are nodding their heads. Do you guys have any comments on that point as well?
Couldn't agree more. I mean, the relationships we've had the most success with, our lead quarterback is phenomenal and summoning resources across, the large banks. They know how to get the capital markets people on, the hedging people on, the lending people on, the aircraft lenders on. They just know how to pick up the phone, get things done, and they clearly have internal credibility to get decisions made at a more expedited level. And back to, I think Sid mentioned, this partnership mindset, that individual kind of, it serves as the glue to make sure that their bank or their institution isn't just treating us as a number. That, and the only time partnership really matters in my mind is when stuff goes bad and it gets challenging. Are they there for us? And do they hang in with us? And we have 20 plus case studies of that after COVID, of a lot of banks, what did they do? What did they not do? How did they hang in? And a lot of that had to do with our quarterback, our lead wealth advisor, and the credibility they even had across the organization.
And Bill, if I could just build on that, if you're that wealth advisor, don't think in terms of, well, I have to be among the top 100 advisors by revenue, let's say. A way for you to break in is to develop this knack. And if you're good at it, your institutional colleagues with these capabilities will start referring the individual business of their corporate executive clients, right? The CEOs, the CFOs, the asset managers, the principals at the private equity firms, because they trust that you'll know what to do with that. You'll take care of that client and won't compromise an institutional corporate relationship with a poor job on the wealth side.
Really a valid point. One of the things I've observed throughout my career, it's a little bit counterintuitive, but sometimes the more junior advisors are the most successful with respect to some of the biggest family offices. And part of the reason for that is because they don't expect that they have the answers. And so almost by default, they have to use the institution. They have to go get the expertise that resides elsewhere in the institution. Sometimes more senior advisors historically haven't operated that way, at least with respect to maybe a bread and butter high net worth or ultra net worth practice, and may not be as much of a conduit to the broader capabilities of a large firm, because in large part they've sort of sold that they were, in essence, the advisor, the product, the value, and they just happen to be associated with a particular firm. So very interesting. Final question, Steve, at least a formal part of this from your perspective. Are there any things that advisors should make sure that they do versus refrain from doing in their efforts to develop relationships, work, and advise family offices?
I'll give you a couple do's and don'ts. So focusing on the don't side of it was something I just happened to have run across recently, but it's something of a pattern, I think, and that is advisors using client investment reviews a little too transparently as like another sales opportunity. Okay, and I think Mike and Sid touched on this. So the premise of a meeting is to review what's going on. So I don't know what you would expect, or maybe you'd think a client would expect about how often might that meeting include pitching a new idea, right? Which is certainly, allowable. I see some private wealth advisors who are successful sometimes trying to get through the review part in 10 minutes or so, and like do just enough of that so that they can turn their attention to, potentially something that could be seen as wanting to ring the cash register. And I'm quite struck by that. And these are among some successful people. And I would just encourage you to resist that urge. And it may feel like the payback on that time you're going to spend really getting further into a family's issues it is good. I don't think a family office will blame you for pitching things, right, from time to time. But I think you'll just get a lot more respect and have a much better success rate with that. In terms of dues, we've covered a bunch of them about incentive alignment, clear, transparent communication. I really like this idea of being almost, I'll say, radically transparent about fees, and almost flipping the script from what most advisors feel the need to avoid the uncomfortable conversation about fees. Differentiate yourself, because that's what happens all the time, and say, I've broken this down, with the help of my colleagues, like all the fees you're paying. I think if there's an idea here to kind of restructure, reorient how things are done, and you can cut your fees in half and double the value you're getting out of this. And that could range from the particular investments. Is it ETFs? Is it managers? Is it privates? But it could also be in terms of service providers as well. So I almost think of, being, some people have this shopping experience of, you sort of go in and have like a personal shopper. Well, I'm sure that term won't resonate with a lot of folks, but, I think if you can demonstrate that you're an advocate in that shopping sense, like I'm going to help you find, and leverage your time as a family office principal or executive, find really the best combination of value and fees. I think that can be effective.
That's very helpful. There was a question with respect to how might a firm sort of leverage families' interest in philanthropy and perhaps related planning around philanthropic ambitions. I want to get to that a little bit later, because I want to stay a little bit on this theme and ask another do versus don't question. And this is for Michael and for Sid. How should advisors navigate this reality that with family offices, you have the principals, those who made the money, and you have the practitioners, those who are hired to essentially help oversee, manage, shepherd, deploy that money. And have you seen some do's and don'ts with respect to that dynamic?
Sure. Michael, you want to go first, or?
I can go quickly. I mean, I would say the first thing you got to know as an advisor is what's the governance and decision-making paradigm of the very family office you're engaging in, because I've been in offices where, yes, you have the wealth creator, and then of course you have the executives that are hired by the wealth creator. But if the governance structure is such that your CIO and investment committee and so on have a lot of autonomy away from the wealth creator, then really the banks and the institutions are not dealing with the wealth creator in that regard. Whereas contrast to the other extreme, there are many, many family offices where the wealth owner, wealth creator is deployed within the family office and is very active in the family office. And so in that regard, you're going to spend a lot of time engaging directly with them and what's critically important to them. You would hope, regardless of either paradigm, that the executives are emulating the same value systems and all these tenets and themes that we just articulated. Because if we're not, we're probably not going to be here long, because we want objectivity, just like our wealth owner wants objectivity. We want fee transparency, just like our wealth owner does. But I think you've got to really learn pretty quickly who's making the decisions and the calls before you can even begin to think about how you're going to engage.
Great. Sid?
Yeah, I would agree with all that. I think one don't is, don't try to go around people. Usually if the wealth creator hired a team, they trust that team and want the team to do work. It's not really a vanity project to hire a bunch of people just to say you have them working at your family office. And so, if it's a situation where the practitioner or the investment team is sort of the day-to-day, and they don't think something's interesting, I think sort of escalating it to the wealth creator really doesn't get you any favors with anyone. It can really actually get the wealth creator and the team at the family office both upset at you, because it's just a waste of everyone's time. And it just shows a lack of, trust and being genuine. So that's a definite don't. Yeah, the other thing I would say is, sometimes it's best to just show opportunities to both, the wealth creator and the team. It just depends again on the setup, right? If you don't know which way to sort of sway in that spectrum, just show it to both. Don't try to hide from anyone, just be totally transparent. I think that's one, major theme of this call, just encouraging folks to be 100% transparent in everything. It buys you, trust, credibility, and it just leads to a much better relationship overall.
That's extremely important advice to advisors, because if you get that wrong, you might be sort of the way JP Morgan is with Elon Musk, right? He does not bank with JP Morgan, unfortunately, because as he publicly said recently, they did something wrong a bunch of years back, and they've been sort of held in the penalty box for a long time as a result of it. So very, very good advice. There's a question with respect to a particular investment strategy. I'll get to that in just a second, because it touches on the first question a little bit with respect to the philanthropy piece, which is what areas of advice and services. You mentioned wealth education. This question is around philanthropy. Sort of these are non-traditional capital markets execution, investment products, lending and banking. Should advisors focus on bringing to family offices, not because they have them, also something that we've talked about in the past, but because they appreciate that these wealthy families need assistance with them? Philanthropy being a good example. Should they be helping you with your philanthropy? Maybe I'll ask the question more simply.
Yeah, they certainly can if they possess the expertise, to do so. I mean, there's so many different ways now family offices and families are engaging around philanthropy. I mean, the most fundamental area that continues to grow legs is just using it as a teaching tool for next generation, transitions in terms of financial understanding of how money is managed, core basics around wealth creation. And so I kind of would drop back to 50,000 feet, and to Stephen's point about, if you're going to be a really good diagnostic wealth advisor, you just got to get in front of the family and family office and diagnose the patient and see where the needs are, and then use all these quantitative and qualitative services as arrows in the quiver to come in and bring solutions. And so if it happens to be that the number one priority at the time you're coming in is philanthropy, then if your firm has some expertise in that area, we have engaged with some financial institutions that have some interesting subject matter experts in the philanthropic realm, whether it's hard to value or hard to donate assets, that how do you value them, and what do you do with them, to networking around impact. And that's probably an area that I'll go back to the topic of proprietary solutions, where we've seen some interesting stuff on the impact side that some of the bigger institutions are doing. So it really depends. And I could use that same philosophy with family governance and a lot of other areas where some of the institutions have hired some really sharp people that have a lot to say and have a lot of experience and sitting with families and talking through the various ways to go about a governance structure.
Great, thank you. Sid, anything you want to add? You had mentioned wealth education at one point.
Yeah, I would add, I guess, maybe to the question. So the prior family office I was at, the Pritzker family office, the two individuals have their own individual foundations, which is a little bit different than my current family office. And so the family office was, much more involved at my prior firm with philanthropy and just thinking about management of those portfolios. And they had a team of grant makers in-house. At the current family office, we don't really have a private foundation for different reasons. So it is more helpful, I'd say, for banks to help us with the education and just thinking about how to best get the next generation sort of thinking about philanthropy. And I think there's a lot of things folks are passionate about. So it's really kind of helping prioritize what are you most passionate about and why. And then at least at our family office, the family is really focused on measuring the impact, not just the feel-good impact, but the financial impact, and making sure that there's real return on the dollar spent. And so I think help bringing that mindset can be really helpful for family offices. The other thing I would mention, maybe sort of pivoting in a different direction for folks at smaller firms or smaller RIAs that don't have an in-house, expert on philanthropy, there might be opportunities to partner with third-party firms that focus just on philanthropy advising. We've also talked to some of those groups as well. And that could be sort of win-win, because they might be able to even refer clients that they're working with on the philanthropy side that need private wealth or private banking assistance or work as well. So it can really be sort of win-win to take that path if you don't have that capability or expertise in-house.
Yeah, look, I can't help but expand on that point in light of my own personal experience, both running a family office as well as running the family office businesses at fairly large institutions. One of the great attributes you've got, either personally or across the institution, are those third-party relationships. So you understand, particularly if you work with other wealthy families, the solutions to the common challenges that they face, and often the appropriate vendors, whether it's in philanthropy or private aviation or in niche investment strategies. And I'll talk about one in just a second. The other thing that the advisor, and more broadly, the financial institutions themselves have, think about all of the families that the institution serves and all of those experiences and insights that come with that. It's very challenging, but I know that a number of institutions have tried to marshal, to convene, to then share those experiences and make their relationships, the institution's relationships, the advisor's relationships, selectively available to other advisors. These curated communities, I hear time and time again, facilitated often by the financial institutions, is of enormous value. I'd be curious if you guys have any comments on that. How about you, Michael? I know that you've been invited to more than your fair share of curated community events across various firms.
Yeah, I mean, look, I think you're spot on that a lot of the institutions have done a great job of kind of creating good consortiums and networks. I think back to my earlier comments about time being limited. I think the challenge now is, and this is a good thing, by the way, that the family office community has become so institutionalized and professionalized. There's a lot of networks out there now. And so you got to pick the right groups that to get involved in that really are going to be additive to the very family you're serving. But you know, I will say and give credit where it's due, some of the larger institutions and candidly, some of the independent RIAs and MFOs have done a really good job of pulling together networks and consortiums of like-minded folks to talk about how to engage in philanthropy more optimally, how to deal with all sorts of, you know, solutions. And that's candidly one of the most exciting parts of my job, but it can be overwhelming now because everyone's got a network, everyone's got a conference, and you've got to pick. If you went to all of that, you know, you'd never get your day job done.
Yeah, it has to be the right network. It has to be the right conference. It's got to be the right content, et cetera, et cetera. Sid,
but there are some great ones out there.
Yeah.
Yeah, no, I think Michael, you know, hit the nail on the head. Don't really have anything else to add.
Perfect. All right. So here's a question, and it opens up, I think, a broader dialogue, although we don't have a whole lot of time, right? So there's a belief that private credit is an attractive asset class right now, certainly over the next couple of years. What are your thoughts? And by the way, all three of you are investment experts. So I'd kind of be curious. I'm not sure if this is a question more about are family offices interested in private credit as much as it's a question about should investors be interested in private credit, and therefore, I guess by extension, should I be bringing private credit out to my investors, including family offices?
Yeah,
well, that's
I'm
gonna
happy
be a
to.
really long answer. I'll let Sid take that one first, but my aspect is yes, 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 and yes. But I'll let Sid go.
I would agree with all of that, and just elaborate. You know, we're big believers in private credit. We've been investing in the space for quite a while. You know, I think the environment today is really ripe for private credit for a whole host of reasons, whether you're looking for yield or you're a total return investor. We like it from a total return perspective, in that we think it's really good risk reward, and that you're senior in the capital structure. You're making an unlevered, you know, double-digit return today, which is pretty attractive, and it floats to the extent, you know, rates stay high or maybe continue to drift a bit higher from here. So we really like that. We view it as sort of a defensive investment overall. You know, I think the one negative obviously is it's ordinary income, but the flip side of that is if you're making, you know, 10 or 11%, a lot of families are happy to pay, you know, ordinary income on that, just because it's a pretty high after-tax return. It's competitive with equity long-term returns, if you think about it from that perspective. Yet it's also more defensive in that it's senior in the capital structure. So we really like it a lot. That being said, I think manager selection, the groups you partner with will matter a lot. It's been a bull market for private credit for the last few years. I think a lot of managers will be tested in the coming quarters and years. So we focus a lot on, you know, how managers put together portfolios and how they underwrite and all that sort of stuff.
Helpful. Steve, we don't have much time. Anything you might want to add, because you're on the other side of that equation oftentimes, meaning you're the one structuring the solutions to take out the people like Michael and Sid.
Yeah, maybe in my past, not so much these days, but yeah. So what I would add is I think Sid's answer kind of underscored something that's really important. Is something can be attractive, you know, potentially on paper, but the implementation is not straightforward. So there's not, in my mind, a suitable ETF that you can go out there. There are public vehicles called business development corporations, but those are complex entities in and of themselves. So you can buy private credit vehicles today, just like a stock, but those need to be understood, even those things. And that's just one way. That's maybe just the most convenient way, not necessarily the best way to get in there. I do think there are some firms, you know, I'll go ahead and mention one firm that I think is doing good work to educate the ups and downs and the pitfalls of this asset class. And kind of advancing the ball in terms of making it more, accessible in a sensible way. So it's a firm called Cliffwater. I know them, but I don't have any commercial relationship with them. I think they do a number of good things in that area.
Great. And then I'm going to just wrap up with these two questions here. One is a continuation a little bit of this, which is how do you take into consideration how do you consider the tax considerations with private credit opportunities? In addition to, how would you define private credit as a broad topic? If there's a quick answer to that question, let's do it. If not,
buy them in your tax exempt account or
exactly.
your Nevada trust or something.
I will say quickly, Bill, I mean, we did in my prior role, we had a very sophisticated private placement structure that we used for our less than tax efficient arena, and strategic credit, private credit, whatever you want to call it, was smack in the middle of that. But we'd take it outside of it as well for all the reasons Sid mentioned. If you're clipping the yields that we're seeing right now, even after tax, if you have limited downside risk, I mean, why wouldn't you take it?
Yeah, indeed. And by that, you mean private placement life insurance, just because you hadn't continued the entire description, just so folks understood the distinction.
Yeah, sorry for the the acronyms. Yes.
Exactly right. Exactly right. There's a question about do's and don'ts with respect to liquidity events. Unfortunately, I know personally that that's going to take longer than we have left. So if you have a question, feel free to reach out to any one of us. I'm sure you can find us on LinkedIn, if not directly through the school. In the remaining moments, I do want to take a moment to thank Michael, Sid, and Stephen. I've known you guys for many, many years, and your insights and expertise are just second to none. And I'm hoping that the participants on this webinar came to appreciate, not just the opportunity if they are interested in going after this very important client segment, which is expected to grow above average over the many, many years, but also how best to do it. And then finally, to have confidence that whether you're a bank, you're a brokerage firm, you're an RIA, and a number of you mentioned, one of the unique things that the RIAs and the MFOs are providing is that there's a place for you. But so much of whether or not you're going to be successful is going to be how you go about meeting the needs, understanding them, and then marshaling the resources of your respective firm or your respective network. And if you do those things well, you will distinguish yourself across the many other folks that are calling on these families. And then I want to thank Tracy Swartz, our executive director, for the program and putting this together, and both Mary and Vicky at Columbia University for helping organize not just the webinar, but all of the work that goes behind the scenes for a very professionally done and technologically issue-free session. So thank you. With that, I will mention again, this is a continuation of a series that hopefully you'll participate in going forward. And if you have any questions about the program itself or would like to reach one of us, go to the Columbia University Wealth Management website. We're all there, and we'd be delighted to be a resource to answer questions, not just about the program, but about many of the issues that come up in these various podcast series. Take care. Thank you, everybody.